Hello, my name is Tim Davies and welcome to our FTS online class. So in the previous two readings, we covered a lot of fixed income definitions. Now we're going on to the valuation. And what we're going to see as we go through this is that we're going to be applying a lot of the concepts that we learned in quantitative methods. So I quite like this because it reinforces a lot of what we learned back there in quants, especially time value of money. The only thing that's not so great about this reading is that it's very long. So I guess we're going to have quite a few classes to get through this reading then. But anyway, we will get through it. So let's get started. Right. So the first thing we need to do is calculate a bond's price given a market discount rate. So the price of a bond is just like the price of anything. It's just the sum of the present values of the promised cash flows. So we're going to use the market discount rate to calculate the present values of these cash flows. And the market discount rate, what it is, it's the rate of return that's required by investors given the bond's risk. So the higher the risk of the bond, the higher the rate of return is that's going to be demanded by investors because to compensate them for the extra risk. But the lower the risk of the bond, then we're going to see the lower the rate is going to be that's going to be required by investors. So this is why it's called the required yield or the required rate of return or the yield to maturity. And as we're going to see as we go through this reading, that a yield to maturity, that is actually an internal rate of return. We're going to be doing it in this very class. So we let something to look forward to. But for now, let us try this example. So we've got Riverside Retail. They've issued a 3-year bond. So they're borrowing money. And they're paying, there's an annual coupon rate of 5%. I just want to stop there for a second because this is, if they don't say anything else, we always assume that this coupon is fixed. So they're going to pay 5% coupon annually here over the 3 years. There's an annual coupon rate of 5%. And the market discount rate is 8%. So if we need to work out the price of the bond per 100 of par value, what do we need to do? We need to take here the future cash flows in all the numerators. So if the coupon is 5%, and we're looking at a par, the price of the bond per 100 of par. So 5% times 100 is $5. So the coupon is going to be $5 every year, year 1, year 2, and then year 3, we've got 105. Why? Because with a bond, we know that the Riverside Retail, they need to pay back the par on the maturity date in 3 years' time. So the final cash flow will be the par of 100 plus the final coupon of $5. Right, so now all we need to do is 3 separate little present value calculations. And then once we've done all those, we sum up the values, and this gives us the value of the bond. So what have we done over here? This $5, we expect that that's the first coupon end of year 1. So we discount it back 1 year at the required rate of return. So $5 in 1 year's time is worth $4.63 today. And we do the same with this one. We're getting this $5 in 2 years' time, end of year 2, discounted back 2 years. So it's worth $5.29 today. And the final payment, the big one, the 105, we discount that back 3 years. So the 105 is worth $83 today. So this is the value of the bond today. So I just want to stop here for a second because this is actually quite similar to how we looked at the value of a share or equity when we did the dividend discount model, except of course the difference was with shares, we had dividends here in the numerator, and also with shares, shares, there's no maturity date. So we had to estimate over here the term, we called it the terminal value at the end of the term, whatever term we were looking at. So there we were estimating what the selling price would be after 3 years or whatever. Now with a bond, we know with bonds, the issuer has got to pay back the money at the end of the term. So we've got more certainty here with this final cash flow in bonds compared to in shares. Right, but otherwise the principles, they remain the same. So if we now, if this is on the exam, we're not going to do 3 different present value calculations. We're just going to plug the numbers into our calculator, and we can use the payment function. Why? Because the coupon, it's fixed. It pays 5% every year for 3 years. So that's like an annuity like we did in quant. So we can use, so if we're the investor, we're going to get $5 a year every year for 3 years, and then the par is going to be the future value. They're the 100, because we're going to get that back at the end of the term. And then the discount rate they've given us is 8%. So this is now the value of the bond. $92, same thing as we did there. So now what we can see is that the price of the bond, $92, it's below its par value. This is what we call a discount bond, because we can see now that the coupon rate, which is 5%, it's less than the market discount rate there of 8%. And if we just think about it for a minute, let's make it simple. Let's say Riverside Retail, they just sell clothes, but now their range of clothes isn't so popular anymore. So investors are only prepared to pay $92 for this future stream of cash flows, right? So they're only prepared to pay below par for this future stream of cash flows. And if they pay $92 today and hold the thing to maturity, they're going to get a return of 8% on their investment. We're going to talk about that in a few minutes' time. But now let's pretend we've got scenario 2. Let's say the market discount rate on Riverside Retail's bonds is 4%. So let's say now Riverside Retail, their clothing range is the best and everybody's crazy about their clothes. So they're very popular in the market. So this means now that investors, the yield they require on the bond, it's not as high anymore. It's only 4% now. So the required yield is going to be lower now. So let's see what happens if this is the case. So only thing we need to change in the calculator is change the 8 change the yield from the required return, change from 8 to 4. And we hit the present value. So now we can see that the price, it's above the par. So now it's a premium bond. So if it was like this, if Riverside Retail was very popular, the company was performing very well, we would expect their bonds to be trading above par, because the coupon rate now is of 5% is above the market discount rate. So if this is in scenario 2, investors are prepared to pay $102 for this expected stream of cash flows, because they perceive the risk to be a lot lower in Riverside Retail. So let us now try another scenario where they're still issuing this bond, but look at the only difference now. Now the bond is doing semi-annual payments, and most bonds work like this, right? And let's keep the market discount rate at 8%. That was scenario 1, when the clothing range wasn't so popular. So now to work out the price of the bond per 100 of par, how many periods have we got now altogether? Well, it's a 3-year bond. There's 2 payments a year, so there's going to be 6 periods altogether. And what's the coupon going to be now? Well, it's not going to be $5 anymore, because they're paying coupons twice a year, which means they're going to pay $2.50 every 6 months. And now what is the market discount rate going to be per compounding period? It's going to be we're going to just divide the 8% there by 2. It's going to be 4%. So now we have to do 6. We have to do 6 little present value calculations. But I guess on the exam, we wouldn't do this. We would just do it on the calculator down here. But it's just good to look at this so that we understand. So let's just do this one over here. So this is going to be after 6 months. So after 6 months, let's just put in, let's just put in there 6 months there. After 6 months, the investors are going to get their first coupon back of $2.50. So we need to discount that back for the 1 period. Every 6 months is a period. So remember, we also in quants, we called that the periodic rate. Hey, we called that the interest rate per compounding period, 4%. And then after 1 year, investors are going to get back another $2.50 over there. So in 1 year, there are going to be 2 compounding periods, right? Because there's semi-annual payments. So et cetera, et cetera. This will be 1.5 years, 3 periods, 2 years, 4 periods, 2.5 years, 5 periods. So this is going to be year 3 here. Let's just put there year 3, make a nice year 3 over there. So in 3 years, there's going to be 6 compounding periods. So this $102.50 in today's money is $81. So then we sum up there the present value of all the future cash flows. So if the bond has a market discount rate of 8%, we as investors, we're prepared to pay $92 today to receive the series of future cash flows. Right, but of course, we're going to do it like this. Say, if it is on the exam, we're going to just make now our number of periods, as we said, are going to be 6, because it's 2 periods a year for 3 years. Our coupon we've worked out is 250. We've discussed the interest rate per compounding period is 4. Future value that remains, the par remains. We're going to get that back at the end. There we go. So I just wanted to then, before we go on to the next slide, have a look at this quickly. Remember the other additional notes that we send you for the additions to the CFA Institute readings, the practice additions to the CFA Institute readings, practice problem solutions. So for these first 8 questions of the practice problems of this reading, the CFA Institute, they were using let me just get rid of this thing here. They were using the time value of money formulas, right? That's what they were doing. But what I did is I solved these questions using the calculator like we've just done at the bottom of the previous slide. So I'm sure this will help you, but maybe look at the formulas as well, because it does help to also understand what's going on. So on the exam, if we think about it, in quants, they might not even ask us one time value of money question, but they can leave it for over here, and then they're going to be applying it to the fixed income section. So we just need to be aware that we can be asked time value of money here as well. Okie dokes. So let's now go on to calculating a bond's yield to maturity. So if we now know the market price of a bond, if they give us the market price of the bond, then we can calculate the yield to maturity, or they call it the market discount rate. And it is, in fact, an internal rate of return. And we're going to see why in just a minute. So we've got the same situation here with our friend Riverside Retail. They're issuing the 3-year bond. Annual coupon rate 5%. Now they've given us the market price. This is the price of the bonds in the market, 92.27. Now they want us to work out the yield to maturity, or the market discount rate. So do we remember, this is now actually going back to corporate finance, that the IRR, the internal rate of return, it's the discount rate that makes the present value of the future cash flows over here, the present value of the future cash flows over here, equal to their cost, which is the bond's market price. So we then need to solve for this IRR. And remember, we have to do it through trial and error if we don't have a financial calculator. But fortunately, we just got to plug the cash flows into the calculator. So the price is now 92.27. So we as investors, that's what we would pay now, outflow. And what would we get back? 5 end of year 1, then 5 end of year 2, then 105 end of year 3. We just hit the IRR button, and there we go. Not so bad. And that if we do now plug in the 8%, you're going to see that the equation is going to balance. This is going to be the rate that makes the present value of these future cash flows here equal to the bond's market price, or the bond's cost. But what we can also do is we can use the time value of money keys. So now it's like we did, almost like on the previous slide, we've just got different inputs now. So we still got 3 periods, because we're talking about annual coupon rate in this example. The coupon is 5, future value 100. So this is, I put that minus sign there in red, because if we don't, because remember this present value amount, it's going in a different direction to the future, this future value and the payments. If we think it from the side of the investor is going to be laying out $92 over here, and then getting back $5 every year for 3 years, plus $100 at the end. So we can have a minus there and 2 pluses. If we'd made that a plus sign, then we would actually get an error on our calculator. Our calculator wouldn't know what to do, because we're not specifying that we've got cash flows going in different directions. Okie dokes. So I think all of us, when we start doing these things, we all make the mistake of forgetting the having a minus sign if the cash flow is going in another direction. But with a bit of practice, we're going to get it right. So just before we leave the slide, I wanted to just mention something, that because once somebody sent me a question, and he was asking me they've given me an example of what, remember the step up coupon bond, where the bond pays higher coupons every year. And let's say it was paying 5% coupon in year one, then 6%, and then 7%. So the guy was sending me an email and he said to me, I can't use this payment function here because we've got different coupons every year. But so how to solve this with a calculator? And then I replied to him and said, why don't we just plug in the cash flows here? You can use this method. So you can make that cash flow 1.5, then this cash flow 2 would be 6 if the second cash flow was $6, and then cash flow 3 if the third coupon was $7, and that would be 105. So sometimes we may only be able to use this method, the cash flow buttons, if the coupon varies. But if the coupon doesn't vary, then we can always use this old-fashioned way, the time value of money buttons. Good stuff. Right. So now we need to look at this yield to maturity in more detail. Why? Because it's so important. It's such an important thing in the fixed income and in the bond world. So what is it? It's the rate of return, the bond, a rate of return on the bond that investor gets, assuming these three things. Number one, the investor must actually hold the bond to maturity to get that return of the 8% that we worked out. And then all the coupon and the principal payments, they have to be actually made by the issuer. So Riverside Retail, they can't default on any of the payments. And then the last assumption is that the investor must reinvest the coupon payments he receives at that same yield, at that 8% that we worked out on the previous slide. So let's now continue on with our example so we can learn some very important things about bonds. So if the bond price falls because Riverside Retail has become more risky, so now their clothing range is getting worse. Nobody wants to buy their clothes anymore. So we can see that the yield to maturity will increase. So let's assume that the credit risk of Riverside Retail, let's say, deteriorates, as we said, because the clothing range is bad. And now the price of the company's bonds, they fall to $80 in the market. So they were $92, that now they've fallen to $80. So now investors are only prepared to pay $80 for that expected future cash, for those expected future cash flows of the bond, not the 92 anymore. So if we now, all we need to do from the previous calculation that we did is change the present value. It was 92. Now we've got to make it 80. So now what? Now we see the yield has gone up to 13%. And it was 8%, if I'm not mistaken. Am I right? Yes, it was 8%. So now the price of the bond has fallen. It's become more risky. So now investors, they require a higher return, right, because of the extra risk. So that's a very important principle. And we're still not done with this principle. We've got more to talk about it. But just before we continue talking about that principle, we can also do the IRR calculation if we want to. And if we just now make cash flow 0, 80 and not 92 anymore, you're going to get the same answer. So I just then double checked, and you can see now if we plug in 13.5% here and not 8 anymore, then the price is going to be $80 and not 92 anymore. Okie dokes. So as we can see, and we've mentioned this already on the previous slide, now we're going to do it again in more detail. Right? So if Riverside Retail becomes more risky, investors require a higher yield. So if the bond price falls, the yield, the investor demand is higher because there's more risk. So this explains an important principle, if not the most important principle of bonds that we're ever going to learn, that the price of the bond goes down, the yield goes up. So we need now a higher denominator over here to bring the price down to 80, because remember the price fell in the market, fell down to 80. So we need now a higher denominator, high yield here to bring the price down to 80. So I just want to stop here for 1 minute and just chat about something we've mentioned in other classes, whereby we've said that the yield or the yield to maturity on a bond, it's very different to the coupon, because we can see the yield to maturity here, this changes as the bond price changes. We can see that, but the coupon is fixed. So the coupon, it's a different story to what the yield on the bond is. And at last we've got here, because we've promised to talk about it, and now we can see exactly that. And I wanted to mention one other thing as well. Oh yes, and that is the problem with bonds is that they quoted either with price or yield. Now a share price is easy. A share price is the share price. It's only price. We don't ever work out yields on shares. But with bonds, so if Riverside Retail becomes more risky, we let their share price, let's say, would drop from $100 to $80. Same with their bonds. Their bonds will also drop from $100 to $80. But now we need to know that with bonds, if the price changes, then the yield also changes, right? Not with shares. So I just wanted us to understand that. Okay, so here we go. Here's the but, and this we're going back to now our yield to maturity. The three things about yield to maturity we learned on the previous slides. So, but remember, investors are only going to get this average return of 13.5% per annum if what? What do they need to do to get this? They've got to hold the bond to maturity. They've got to receive all of these payments to get the 13%. Number two, all coupon and principal payments, they must be made by Riverside Retail, so there must be no default over here by them. So let's say Riverside Retail, they get into trouble now, and they don't pay all the coupons, or they pay less than par at maturity. Then what will the investor get at the end of the day? At the end of 3 years, the investor is going to get less than 13% per annum. So just for fun, what I did is, and I just want to get my book out here because I wrote it in my book somewhere here. I worked out, let's say, for example, Riverside Retail, instead of paying back $100 at the end of the 3 years, they only pay back $80. So now what will cash flow 3 be? Cash flow 3 was only going to be 85, because they're paying back $80 of the 100. Let's say they do make the last coupon, though, that they do pay that back. If you now plug these numbers in, and instead of using 105, you use 85, you're going to get a total return that the investor got was only 6.25%. That's what I worked out. Or what you could do is here, for this future value, you could plug in 80. If you plugged in 80 there for the future value and not 100, then you're going to see that the return the investor get was also just 6.25%. Right, so I just wanted us to understand that. Good. And the third thing, you're only going to get the 13.5%, remember, if we reinvest the coupon payments we get at that same yield. We might not be able to, but it's just one, but often we don't reinvest at the same yield, but it's all we've got to work with. But if we do all bonds calculations the same manner, then it's fine. Then it's apples with apples. Okie dokes. So now, okay, this calculating the value of a zero coupon bond, I want to come back to, I'll tell you why, because while we've just done this, price down, yield up, we've gone through the whole story. Let's go straight onto the relationships between bond price and bond characteristics. And this is now done, right? If the market discount rate goes up or the yield to maturity goes up, we've seen bond price down, and it's vice versa as well. We worked the other way around. We said when the bond price went down to $80, the yield went up, which means the other way works as well. If the yield to maturity goes down, the bond price is going to go up. Right. So now another thing we need to know is that when the yield to maturity of a bond goes down, the percentage price change is greater than when yields go up. So we've got a little example here to explain that. And this is actually good news. So when yields go down, the price goes, when yields go down, the price goes up. So we get a greater amount of price increase than we do price decrease when yields go up. So let's see. So we got a 3-year bond, annual coupon rate 5%, and I put the coupon in green for a reason. We'll see at the bottom of the slide. So now when the market discount rate is 5%, you guys can just plug in the numbers there and check that the present value of the bond is 100. But now let's say market discount rate is 3%. So the bond has become less risky. So the market discount rate now only 3%. So now if we plug in 3, the only thing we need to change from above is make the discount rate 3%, not 5 anymore. We hit the present value now. If it's less risky, we're prepared to pay more. We're prepared to pay $105 for the expected future cash flows. So what's the amount above par? $5.66. So the yield has gone down. The price has gone up, like we saw above there. Okay, so yield down, price up. Now what happens if the market discount rate goes up to 7%? So in other words, the bond has become more risky. Investors demand a higher return, they demand a higher required return. So only thing we need to change is the 7. Of course, the bond price is going to fall now. Investors are only prepared to pay $94 for the expected future cash flows. So now, what is the amount below par? It's $5.25. So yield has gone up, the price has gone down. So now we can go back up here and see what we said is true. When the yield goes down, like over here, the percentage price change is greater. We went up $5.66 compared to when yields went up. When yields went up over here, the price went down 5.25. So the price of the bond is going up more than it is going down for the same change in yield. Okay, we changed yield 2% down and then 2% up. And they call this the convexity effect. And we're going to be doing that in a lot more detail in the next study session. Excellent. So this is why I put the coupons here in green. So here we've got the coupon rate in green. So in the first scenario, the coupon rate was the same as the yield to maturity. The yield to maturity there is in red. So there we can see the bonds at par, right? And then what happens if the coupon rate now here, it's 5, it's greater than the yield to maturity of 3. So it's greater than the market discount rate of 3. So now it's going to be the price is above par, like we see above. It's a premium bond. And what happens then lastly, if the coupon rate, the 5%, is now below the yield to maturity of 7 there, the coupon is below the yield to maturity or market discount rate of 7. So now the bond price is below par. And of course, there it's below par, and we call that a discount bond. Excellent. We've got more relationships that we've got to know over here. And remember, relationships are very important for the exam. So let's see the next ones that we've got here. So for bonds that have got the same time to maturity. So remember, we discussed in the previous readings that, different bonds have got different maturities. We're going to have like 5-year maturity or 10 years to maturity or 15 years or whatever. So let's say we've got 2 bonds and they've both got 10 years to maturity. So now when the market discount rates or the yield to maturities, when they change by the same amount, the bond that's got the lower coupon, that's going to have a greater percentage price change than the bond that has got the higher coupon. And they call this the coupon effect. So which bond has got the lowest coupon of them all that we discussed in the previous readings? Of course, it's the zero coupon bond. So the zero coupon bond, that's going to have the greatest percentage change in price when yields change. And another way we can think about it, let's say now we work the other way around. We got a bond that's paying a high coupon. This means more of the bond value is going to be received earlier if the coupon is higher. So therefore, for a higher coupon bond, it's going to be less sensitive to changes in price when yields change. Right. So now the next relationship we're going to know is that for bonds that have got the same coupon rate. So let's say we've got 2 bonds and they've both got a 5% coupon rate, for example. So now when market discount rates or yields change by the same amount, the bond that's got the longer term bond, let's say we've got one bond that's got 10 years to maturity. So let's put a 10-year in there. And we've got another one that's got 1 year to maturity. So the bond that's got 10 years to maturity, that's going to have a greater percentage price change than the shorter term bond is going to have. When they call that the maturity effect, which makes perfect sense because the longer term bond it's more risky. There's much more uncertainty, about the bond's cash flows 10 years from now compared to 1 year from now. So we'd expect the shorter term bond to have less sensitivity to change in yield, and the longer term bonds to have more sensitivity to the changes in yield. Right. So unfortunately, there is a damn exception over here. So there can be an exception for low coupon, but not zero coupon bonds, for low coupon long-term bonds that are trading at a discount. So in this situation, what we can have, if we've got a long-term low coupon bond that's at a discount, it could actually change by a smaller amount. Let's put an S there, and that's going to be the exception. The exception is going to be that this bond trading at a discount, and it's got a low coupon, could actually change by a smaller amount when yields change. But it is an exception. We don't have to go into all the detail. It's quite complex why. We just got a note like that, but it's not very common that we see this. The general rule is the longer the term of the bond, the more the price is going to change when yields change. So then this maturity effect, then it always works for bonds that are at a premium. Okay, only the exception is only for discount bonds and bonds at par. It always works for bonds at premium and at par, and it also always works for zero coupon bonds, because the exception says not for zero coupon bonds. And just before we leave the slide, one way we can remember it for the exam, we've got an L over there, and we've got an L over there. So lower coupon bonds change by more, and longer term bonds, they also change by more. Right. So that is a way we can remember it, that L's, both the L's, they change by more. Right. Now, the last relationship we need to know is this thing called the constant yield price trajectory. And this shows the change in the price of a fixed coupon bond over time if the market discount rate or the yield to maturity, if it remains constant. So we'll see now in the example how this works. So as time passes, the bond price is going to change, even if market discount rates don't change. Why? Because we know what the investor gets. They get par value at maturity, and this is called pull to par effect. So let's stick with our same example we had before, the 3-year bond, annual coupon rate 5%. We had before, 2 slides ago, I think, we had a scenario when the yield to maturity was 7. We had the discount bond. If you go back there, you'll see there the price was 94. So over here, with 3 years to go, this is the price of the bond, $94.75. Now, what happens after 1 year? There's going to be 2 years left. Eh? So now there's 2 periods left only. So N is going to be 2, number of periods 2. So the important thing now is that we're going to keep the yield to maturity constant there at 7%. That's the whole thing. That's called the constant yield price trajectory. So if we keep the yield at 7, we see now that the value is 96.38. And then after 2 years, how many years to maturity? 1, right? So after 1 year, if we keep the yield at 7, it's going to be there 98.13. So we see that's what we call there the pull to par effect. If it's a discount bond, and if it's a premium bond, it's going to go the other way. So just before we leave the slide quickly, let's just talk about this. Because we're going to do this actually in the next study session when we look at the risk and return in that risk and return bonds reading. So if we sell a bond after 1 year at 96.38, then there's no capital gain or loss, because that is the constant yield price, the constant yield price trajectory, that price we're going to be using. But let's say we sold the bond here for 97 up here. If we sold the bond for 97, we got to compare it to the constant yield price trajectory of 96. So there is going to be a small capital gain over there. So very important, when we work out the capital gains in the next study session, we're going to compare the price we sell at to this price over here, the constant yield price, not what we paid for it. Very important. And that we're going to be doing then in the next study session. So it's many classes to come yet. Right. So that's the end then, except that all we wanted to cover in this online class, except for one thing. Remember, we left out the zero coupon bond because we wanted to go straight onto the relationships. But this is nice and easy. Let's just do this quickly. We just go back here to the zero coupon bond. So it's nice and easy now. We got it. Let's try the example. Zero coupon bond, yield to maturity 6%, matures in 4 years. So what's the value of the bond per 100 of par value? Well, all we need to do now is our basic present value calculation because there's no coupons. So remember our formula, present value over here, that's what we're trying to work out, is equal to future value over here, right? So our future value, now we're going to get $100 in it's 4 years time. So we're going to discount it at the yield to maturity of 6%. We discount it back 4 years. So this is the value today. So we as investors, what will we do if we invest in this bond? We will pay $79 today, and we're going to get $100 in 4 years time, nothing in between because it's zero coupon bond. And then these are the calculated steps, just like a normal present value calculation that we're good at. I'm not going to worry about that. But now I just want to talk about this for a minute because we can do the same example, but use a semi-annual basis. So why would we want to do that? Because if we do it on a semi-annual basis, then we can compare it to any bond that pays coupons semi-annually, like because most bonds actually pay coupons semi-annually. Then we can compare apples with apples. Like, for example, US government bonds pay coupons semi-annually, which are treasury bonds, and most of them pay like this. So if it's on a semi-annual basis, it's easy. We know what to do. We now got 2 periods a year for 4 years. So we've got 8 periods, and our interest rate per compounding period, we just divide by 2. So our interest rate per compound period is going to be 3%. So there we go. There's our interest rate per compounding period there, the 3%. And we've got 8 periods altogether now, because 2 periods a year for 4 years. So that's 78.94. Or we can use the calculator buttons there, the time value of money buttons, if we want to. Good stuff. So then that's the end of that class. So just practice lots of examples, practice all the calculations, do all those CFA Institute practice problems that we looked at quickly earlier on. And then this will all become fine. Just apply our quant stuff and we're going to master this. And we'll see you in the next class. Hello, it's Tim here again. I hope you enjoyed the class and found it beneficial. We have some classes available for free on YouTube, but we have classes for the entire curriculum. The classes that are not on YouTube can be purchased from us. If you'd like to purchase the classes, please contact us for the pricing, and I've put our contact details over here. You can purchase all the classes or certain readings that you would like. When you purchase the classes, we provide you with the slides and our notes. I've assisted hundreds of candidates pass CFA exams, and I look forward to also helping you through the CFA program. I've put in 2 testimonials in the slide over here, and we also have a testimonials page on our website that you can review. I look forward to seeing you soon, and all the best.